Well, good afternoon, investors. Welcome to our first bull session of the month of June 2025. My name is Mark Robertson. I am joined here by my dear colleague, that magnificent mathematician from Mid-Michigan, Ken Kavula. Good afternoon,
So
sir.
did you get my new picture that I sent you, Mark?
Is that the one you want me to use from now on, or?
That's a brand new picture of my thinner face. Okay,
Chiseled. He's chiseled, folks.
not chiseled yet, but much thinner. So
And we're gonna try to roll through a pretty substantial program here today. So I will talk fast so that Bob Shaw can't use the 4x speed or whatever it is he does with our broadcasts on YouTube. We're joined here by also Indiana/Florida's Kim Butcher. Good afternoon, Kim.
Good afternoon, everyone. Hope everyone's doing well.
And we'll be rolling around in one of her favorite areas, cash flow. So we'll have some fun there. We're also joined by Houston's own Matt Spielman. Good afternoon, Matt.
Good afternoon.
Anything hot down your way?
Well, everything's hot down this way. These are the days, if you want to buy ice cream, you need to do it either before 8 a.m. or after 8 p.m. or else you have a chance of getting home.
Or you have to eat really
Stay in the air conditioning.
No joke. Yeah, you bring the ice, the bag with the ice in the store.
Good
so
stuff.
you can't walk around in the streets of town with your ice cream cone, then, right, Matt?
Yeah, you better eat fast. Get a small.
All right.
Not unless you want to droop and drop. Could be an ugly situation. All right, we're going to spend some time here continuing our discussions about cash flow and what it means, and trying to extract some strategies and philosophies. And we're going to introduce our cash flow aristocrats here in a couple of minutes. Then we're going to spend just a few minutes talking about the guys down in Illinois, at the heart of Illinois, had brought to our attention that David Gardner did a good session on rule breakers and value, establishing value. So we'll talk a little bit about that one also, but that is what is on the agenda. Let's go ahead and roll. Let me double check and make sure that we're okay there. We are. All right. Hey, I moved the disclaimer up. Probably.
Here we go, Mark. Listen to this, Mark. Blah, blah, blah. Those are our emails at the bottom. If you want the slides, email Mark. Next slide.
Is somebody suggesting that?
No, but I am.
All right. Well,
I think we are not the boss of you is the good short summary.
Yeah, that actually summarized the slide. However, I am legally required to say no investment recommendation is intended. So we'll go ahead and do that. If you want anything, you have future questions or suggestions, the two email addresses at the bottom are useful. And again, Debbie, if you want to send that request for a question, either one of us, that the two email addresses there. All right. Good to go?
Good to go.
All right, we're not going to spend a whole lot of time with Portillo's either, other than a quick reminder that mustard is the only thing that belongs on a hot dog, along with a few other acceptable alternatives. Portillo's is not a sponsor of this session, although they should be. And I offer the visual evidence of the last 2 years using that Ishimoku cloud, which clearly shows that relish is better than ketchup. And that's where we're leaving it for today. I'm actually pretty close to my cost basis for anybody out there wondering.
Every time you say that, it makes a wrong turn. I don't know if I'd say that, Mark.
Good point. Good point. I think Kevin Galogli is out there working against us. All right, just a few themes. We are going to be talking about cash flow here in a few minutes. We do celebrate the fact that we are part of a relatively small bunch of people who are doing all they can to accomplish stuff together. And we do pretty well collectively as a community. That's the point there, Ken. And then I think the big challenge for all investors is kind of summed up in that this notion of time and how powerful time is. So we are going to be looking at a few companies over a 10-year period. That's a pretty decent length of time for starting to make some judgments. 1 week or 1 month or a quarter, none of those fit that description. Anything you'd like to add, Ken?
Well, I know that the younger generations like to tell us boomers that we're used to delayed gratification, but in the case of investing, I think delayed gratification is something that you have to get used to if you're going to be a good investor long term. So I'm very happy with delayed gratification.
And we're demonstrating delayed gratification with the Buttonwood portfolio right now. So that's all I'm going to say about that. All right. What's the takeaway here, sir?
Well, we're still staying pretty close. My par at 10, value line at 10.7. That green bar has moved a little bit closer to the red line. What that means is that we're coming closer to an average return for the market. And we've been saying for years now that an average return for the stock market, depending on what the benchmark is that you're going to use, but an average return is somewhere around 9.5, 10, 10.5, 11, 11.5%. And we're right smack dab in the middle of that fairly wide range. 10 is a good number to use if you're rounding everything off. And there's no reason at the moment to be lamenting anything. We have a little bit of space between the light green bar and the red line. That means a little bit more room to play around with growth before we get really overvalued. So let's enjoy it while it's here.
I will tell you that I don't watch a whole lot of CNBC, and I very rarely talk to my TV set. But I was watching a little the other day when a young lady was on there talking about how grossly overvalued and overbought the stock market is. And I was basically screaming back at her, no, it's really not. And this would be my evidence. There are some stocks that may be a little bit overpriced, but
I do think, Mark, if you're an analyst that only concentrates on eight stocks, then there's a lot of times when you think the market is really, really overvalued. But
okay.
if you concentrate on 5,000, then I think you have a decent chance of understanding that there's a little bit of wiggle room left in the whole market.
We'll give her that one. So what's the best thing for being sad? Asked young King Arthur. The best thing for being sad is to learn something, Merlin. And yeah, we like doing that. So let's set course on doing that. One of the things that we can learn from each other is don't use Mark as a source of groundhog ideas. All right, Ken. I
think we learned that years ago, Mark. I don't know.
Well, I have been in a bit of a slump for the last year and a half, and I'm grumpy and getting tired of it. So
grumpy, okay.
It will change. It will change.
I think we can find a picture of Grumpy and put it on the next slide, you know?
Well, what I'm not grumpy about is the fact that 54% of you are beating the market. That's outstanding. And there's some real time-honored regulars on this list of 50. And I do like seeing that also.
I think we're close enough to maybe turning that average groundhog return into green numbers, Mark. You know, negative 1.1 is doable.
I'll bet you we're close right 2%. Now.
Yeah, we moved over 2% in 1 week here, so we'll just have to give it a try and see. The Wilshire's doing its darndest to get into positive territory. So,
and that's since Groundhog Day for anybody trying to do the math there. And I sum up my condition with the fact that I am sub-monkey. And it's unpleasant.
And we'll leave it at that, right?
And I'll go ahead and do the bragging for the Wolves and point out that Ethan Dunman at number 5 and Don Sheets, they're both in Ken's Investment Club. One of them is his grandson. They continue to be at the top of the chart. So more to celebrate, more standing ovations in their future.
Yay, we had a meeting last night and they were feted, truly feted. It was nice to hear there, okay? I see that we don't have anybody new in the that top 10, do we?
No, they just all kind of shuffled.
Yeah, they shuffled around. The top 10 shuffled. The top 10 numbers are on the list in both columns. They're just in different orders. Yeah. Okay.
The biggest movers are Robin Ware at 16, and I see David Einhorn has had a few hot days apparently. And
Kurt's
Ellen
no
Hall.
slouch either. Yeah, Kurt has moved up to above 20 now, Mark. We got to watch old Kurt. He's ahead of some of the real big hitters down here on the list. So.
Yeah, and Ellen Hall has been at the top of the charts for years. She's been a participant in 18 years of the contest. So, and she's always turned in pretty good results. Good to see her on the list also.
Is that how long you and I have been in? 18?
Yeah,
Is that that's
yeah.
the, okay. All right.
All right, moving on.
It was a lot easier to be in the top 40 when there were only 80 people in the contest, Mark, you know?
Yeah, and the first year with only 20, 20 felt pretty good. But when you're only competing with 20. All right, we're going to launch the subject or continue the subject of really digging into cash flow. And I just wanted to share some observations and thoughts. Up at the top, that's the classical definition written by an accountant of cash flow. They always seem to start at the bottom line and work their way back as they define stuff. And as I told the audience last week, I had recently reread The Evaluation of Common Stocks by Arnold Bernard. Who's Arnold? He's the guy who invented Value Line back around 1930. And he wrote this book around 1958. And I said, well, you know what? I'm tired of reading this definition backwards. Let's talk like a human. And basically asked, well, how would Arnold likely define that today for us, starting at the top line? And really what cash flow is to me is the cash left after you pay the people and you pay for the stuff to run your business. And then everything else below that is a management decision or a structural decision, corporate strategy, capital structure, all that stuff. But we want to stop at the point where you've taken your revenues, you've paid your people, and you've paid for the stuff that you need to run your business, and then take a look at that point basically on the income statement. So again, the entire book is written in the context of the ability to pay dividends, because dividends were so relatively large back in that time frame from the 40s, 50s, and 60s. They were much larger than they are today, so it was a much bigger component of the thought process. But if you go back and look at the book in terms of just generating, cash flow in order to enable earnings and dividends, I think you're pretty much there.
Mark, help us out with SG&A.
That's just sales, general, and administrative costs.
Okay.
So, anything else here bother you, or are you good to
No,
go
I'm
so
just
far?
good to go. It makes sense, and it's a nice, simple definition for most people. They can understand what cash flow means. And now we're going to talk about how you might use it.
All right. So what we want to do is, most of you are familiar with this thing known as the dividend aristocrats, and I just had the thought, why not have cash flow aristocrats? And so I went and looked. There is no major entity or enterprise actually putting anything out. There is one ETF that does a little bit of this stuff, but I could find, I Googled a bunch of stuff and used AI, did not find a whole lot of hits on it. And there certainly is nothing out there terribly active. So we're going to basically try to create this list of cash flow aristocrats. And I will tell the story. Ken and I had finished a presentation down in Dallas a few years ago, and a lady walked up at the end of the presentation and she said, "Do you know where dividends come from?" And I paused, and I'm not really a big dividend guy, but I said, "You know what? They come from earnings." She goes, "No, that's not really true." I said, "What do you mean?" And she says, "Well, they do, but it all starts with cash flow. They come from the checkbook. And you got to think about, how much cash, how much ability to pay those dividends is in the company's checkbook." So that's where this kind of stuff all rolls around in my brain anyhow, Ken. And that's kind of why I wanted to go down this path.
Well, I'd like to see us with another tool in our quiver to evaluate stocks. And we know that Value Line uses cash flow in a lot of different ways to come up with some metrics. So let's delve into it and see where we go with it.
All right, so this is what Arnold Bernard's invention became, the page that you recognize as the Value Line company report page. On the company report page for any company, with the exception of some of the asset-based companies, they all have this cash flow, either per share or per ADR, and that's what we're zooming in on here. And we're looking for companies that have had increasing cash flow for 10 consecutive years. So that's what the green arrows are for. You can see that the numbers are steadily increasing. You can see the math down below of the percentage increase, and there's a 10-year average there. And then over to the left, you can see that, yes, there is a cash flow. And in fact, there is a cash flow growth entry in the annual rates box for Value Line. So this is the type of thing that we want to be looking at for this company. You can see that, by the price chart up above, it's been going through a few years of trials and tribulations or whatever. This is a company that's located in a war zone, and but it's been a very successful company. It's a global provider of call centers and that type of stuff. Very, very well established company, very respected, and one that I think is worth a closer look.
Mark, I have two comments from our audience. Patricia Bailiff says that was her that asked that question to you. So now you
That's
have
right.
a name to put to it.
Thank you,
Okay.
Patricia.
And then Sharon Saris out in the audience says, what's the difference between cash flow as we're talking about it and free cash flow? Or are they the same thing?
They're pretty close to the same thing. First of all, I think free cash flow is used a lot more because it's sexier. It sounds cool. But what it basically is taking the cash flow and then adjusting it for capital expenditures for the most part. Now, there's some other stuff that's involved, but for the most part, it reflects management decisions to enter into capital projects to run their business. So they're actually making that adjustment and they're putting a dent in the cash flow to account for that type of stuff. We want to stay above that. Value Line always wanted to stay above that line. Now, that's not to say free cash flow is bad or unimportant or anything else, but we're basically saying that's a management decision down below the cash flow line. So that's the way I think of it. But that's a great question. Great question. Okay. So let's keep moving along here. Here's what it looks like in graphical form. That this is still nice. And this is the cash flow history. By the way, that jump up in 2016 to 2017 is when they really began to hit all cylinders on their AI implementation, with their cost centers and the stuff that they are doing in their business, serving customers. And this is truly a company that was doing artificial intelligence way before it was cool. And that's a point that Ken and I have made with not only this company, but Excel Services and companies like that. So you can see it right here. This is a very steady, pretty picture when it comes to cash flow.
Yeah, they weren't even calling it AI. They were calling it machine learning at that time.
That's right. And again, we're kind of modeling this entire thought process based on Charlie's work up above, or his quote. And we think that that's a good guideline to at least understand the company at multiple levels and use that to help us make some decisions. So here are the companies, at least so far. This is a list that is taking shape. There could be some omissions in here, and we will correct that. But it's a pretty comprehensive list for now. We're calling these guys the cash flow aristocrats. And they are ranked by the return forecast from projected annual return from highest to lowest. And I think, does this pass the Kavula test, Ken?
It does. All the lists on the current presentation pass my test, Mark. In other words, I own 2 or 3 on the list, so it must be a halfway decent list.
At least they're operating in your sandbox.
Yes, they are. The same sandbox.
So again, you see some fairly powerful cash flow numbers. Some of the companies are a little more mature than others. Altria Group, some of us don't care for tobacco so much, but Altria Group has been a pretty steady company over the years. By the way, they have a 7 or 8% dividend yield right now. So that's part of the picture there. But most of these companies are fairly well known. I was really kind of taken aback by EMCOR making the list in such a strong manner. And engineering and construction, we've talked a lot about Comfort Systems and Ken's IES Corporation. You can see Quanta's on here also. That's another Houston-based company that's more commercial and industrial, but there's a pretty good track record. So these are all companies that have a 10-year track record of improving earnings. Notice that O'Reilly's on there. We've talked about O'Reilly quite a bit around here.
Mark, you mean improving cash flow, right?
Yes, yes.
Okay.
What did I say?
And
Earning.
earning. Yeah.
The
And
tough
Mark,
habit to break.
I'm looking at the Costco before anybody calls you on it. I'm looking at the Costco value line. And here's another earnings aristocrat. I'm sorry, cash flow aristocrat to add to the list.
Okay.
You're
Somehow
going
I
to want
missed
to
it.
take a look at it. You're going to want to take a
Well,
look at it.
part
It's
part
pretty
of
dramatic.
okay. Well, part of that is the fact that I switched some accounts around and I forgot to buy it back a couple years ago, and I'm still bitter about that. So Costco is invisible to me right now.
All right.
No, just kidding. All right, so here is where the rubber really meets the road, and I had no idea I was going to end up here. This is our traditional performance perspectives page. Keep in mind here that we are doing a 10-year look back for all of these companies, and I have substituted, instead of the most widely followed companies at Manifest, we have the 20 aristocrats. I'll have to add Costco. Trust me, Costco will be up at the top of this list also when it comes to annualized return. But just let your eyes roll down this list of these numbers and then do an average in your head. And even with these down here that are a little bit less, you get this number. And that's enough to get my attention. Your thoughts, Ken?
Well, my thoughts are, Mark, I'm looking at the bottom of the list. And, if you were to tell me that I could make a 10-year investment that's going to make me 9%, I still think I'd take it, even though it doesn't match the market. A lot of people take that risk because they buy index funds, and a 9-10% return for an index fund is not unheard of at all. So I think this is a list that gives us, like any other screen, like any other metric, it gives us a great list of stocks to study. Nobody's telling you right now that this is a list of buys.
No.
All we're doing is showing past performance, and we're suggesting that these are very interesting companies. I pointed out to Mark that Badger Meter, which is a company that we hardly ever talk about, but Badger Meter has been on that small company list that comes out of Better Investing Stock Screener. When you screen the small companies predefined screen, Badger Meter has been on that list for probably 18 months, maybe longer than that, which means it's a pristine growth company. So look at some of these companies. If you're not familiar with some of the names, here's a to-do list to start with. And then when they end up being at 10, 11, 12, 13% potential return, don't be afraid to throw some money in them just because you happen to know the name. I convinced clubs that I belong to get real heavy duty into Microsoft about 4 or 5 weeks ago. We've been very pleased with the results because Microsoft hit not an all-time low, but it hit an extremely low number back at the beginning of April sometime.
Mm-hmm.
When you find companies like this that you're pretty sure are going to stick around and they move into a trough, that's a great time to add them to portfolios. Nothing on the list is a buy right now, folks, but everything's open for study.
Well, there was one that was a little bit attractive. Nice is up there, and that happens to be down here right now. So the thing I noticed about this was, in addition to a handful of community favorites, most of those are a little bit off the beaten path.
I agree with you.
And we've for a long time we've talked about how you don't need to necessarily find the next Microsoft, and we say you need to find the next Biomet. Well, in this case, you could substitute a number of these names in for Biomet and do pretty well with them. So again, these numbers are just off the charts spectacular. Anything greater than 5 is just wow. And I was kind of stunned by it. So stunned I had to go check and make sure that the spreadsheet was behaving. If anybody can tell me that there's anything wrong with this picture, step up. I mean, that's pretty much up and to the right, showing you basically a 20% plus return over a 10-year time frame for Comfort Systems. With a bit of an excursion, this is that excursion that Ken was just talking about. on the right-hand side of the chart. All right. All right, so let's talk about the companies that just missed the list. And these are any companies that had one bad year in the last 10. And the bad years are times when the cash flow actually went down, didn't go negative, but actually decreased year over year. So the company at the top that you see, Deckers, when this year rolls off at the end of this calendar year, companies like Decker will become eligible because all these numbers are positive all across the rest of the page. So you can kind of see from left to right, the shaded in areas, companies that were probably impacted by COVID. There's a lot more red numbers in that field in the middle, and a lot of that had to do with COVID. And I did.
Well, and there's a number of companies in that shaded area, Mark, that we can immediately make amends for. I mean, it's not unrealistic for us to know why Texas Roadhouse, for example, had negative cash flow in 2020, or when people stopped buying things, why Visa and MasterCard both had negative returns in 2020. So there are some of these that have very legitimate reasons for that negative number in one or two of these columns here.
In fact, I would be persuaded by an argument that year is so unusual for Texas Roadhouse that it almost should be set aside. Of course, then you start getting into the hairy, how do you decide when that happens for a company like this? But
and we have the same thing going on for Arista Networks. It's not quite as clear cut as to why it would be negative, but we know a lot of companies were having trouble selling anything during that first year of COVID. It was extremely disruptive. I just hope we remember it and don't allow it to happen again.
Now, this one falls off the list for Apple, but there's another one over here. And Apple has weakened if you look at the relative size of those numbers in the last few years. So it's slowed down as a cash flow generator a little bit, but just kind of an interesting list from side to side. The one that just kind of knocks me out is Fortinet. Look at these numbers. 80, 80, 80, all the way across. And then there's this one here, which is, again, that's an estimate for this year. Maybe that's off, who knows? But look at this number. I mean, the company has just been generating more and more cash flow. That's Fortinet. It's a company that Ken recently featured. Was that a roundtable edition, Ken, or not?
I don't know where I featured it. I did it at Ticker Talk. I don't know if I did it at Roundtable or not, but it's a cybersecurity company and a very, very easy to study cybersecurity company, pretty straightforward and beautiful visual analysis. I'm looking at MetaMark. Was that the year that Mr. Zuckerberg decided to change the name and the direction of the company?
I'm pretty sure it was. That's when we left the party, so yeah.
And 2023 would be when everybody told him he was crazy and go back to what you were doing, right?
That's right. So it's just kind of a fun list to look at. Domino's Pizza's on there. Paychex makes this list. AristaNet is a strong company. Google's on this list. Interesting. Here's what they look like in the same list. I just classified them as cash flow honorable mentions. Again, some of them a couple of those will qualify for the aristocrat list. This year, a couple of them will drop off completely. But again, you see some fairly interesting numbers, fairly decent cash flows. A couple of them are attractive. I think that potentially Deckers is overreacting to the situation. Ken's worried about their sourcing, their global sourcing. That's a fair worry. But some fairly interesting companies. This one passed the Kavula test. I think it does.
It does. I own 3 or 4 on this list too, Mark. In fact, we discovered that I own more on the honorable mention list than I do on the aristocrat list. So, there's a lot of good companies on this list. A lot of good companies.
And I think that basically says that we are a forgiving community, because if you look at all these bolds and blues, these are the companies most widely followed, or they're in the roundtable tracking portfolio, and we basically are a forgiving community. We don't care about that one bad year. We're willing to let these companies in the clubhouse. So, one more feather in our cap.
Hey, Mark, one other comment on this list. Before the broadcast start, we had talked on the prior slide about those companies whose bad year was 2016, that perhaps they will naturally fall off. That led me to a little bit of poking around, and Grok is still looking for other examples, but I'll say ELF Beauty, which is a cosmetics company I have no business owning but do, will also join this list. It didn't exist in 2015, but it does have 9 straight years and is projected by Value Line. It's actually on the regular Value Line, was projected to be added to this list next year if it holds up to expectations.
Oh, very cool. And if anybody spots anyone like that, go ahead and send it in to us. And yeah, I think this could be a very interesting thing. Obviously, the next step will be to identify those companies with 8 or 9 years of established track record that are on the verge of making a list like this. So we will be looking for that sort of thing, and we'll also be looking for some screening on cash flow characteristics also.
Yeah, it's a pretty easy check. If you're looking at the Value Line, folks, just go down to the second line in the grid, and it says cash flow per share. You couldn't be any clearer. And then you're just looking for positive numbers from 2016 through the 2025 estimate. And if
increasing.
you have that, then increasing, and then it belongs on the aristocrat list if that's happening.
So we'll refine that, but all of the above is true. All right, so that we'll obviously move on to the screening stuff that I just mentioned, and have some fun with this and build it out completely. But again, I'm staggered by those return numbers on the previous slide. Anything else here, Ken?
No, I think we're covering it pretty well, Mark.
I do think we have a need to make sure that this list is properly populated by some of those stocks that we saw on that page. We are doing a little bit better. We are up to almost $4,300 this afternoon, and we actually have turned positive for a rate of return since inception. But we are not going to do anything with Buttonwood today other than to show you the snapshot of the portfolio and remind you that we will be looking at this to take, probably some gentle trimming and action a week from today. And just a quick look at where we stand. Again, this afternoon up at 4,300, we're probably doing just fine. And the past month it's trickled back to about 3%. This was a very good day. Hopefully we're having another one of those, Ken.
I hope so.
All right, so that's next week, on the agenda for next week. All right, thought we'd spend just a moment talking about, we'd kicked this around with the Heart of Illinois gang. David Gardner did an interview back about a week ago, and you can actually get to that interview down at this link where we basically talked about this rule breaker approach to investing. We have talked about it a number of times at Manifest, and I just wanted to remind that you can go to YouTube and get some of these presentations. You can use any search engine or chatbot and find a wealth of stuff when it comes to David Gardner and rule breakers. And in fact, Matt, you would enjoy this. I actually found where Manifest Investing was cited and used for some of the analysis at Grok or Perplexity. I don't remember which, but it's good, clean fun.
I'm sure the royalty checks are coming.
Yeah, I keep waiting for that. Just like my RV picture that's just now up over 500,000 views, and I don't have anything to show for it. Good stuff. So we're going to talk a little bit more about these rule breakers. It's a subject that we have covered in the past. Another thing that I did for demonstration purposes was to take that YouTube link and basically load it into Notebook LM, and Notebook LM generated this. I added the picture. That's the rule makers book from a few years ago. And I'm pretty sure during the presentation, David mentioned that he's coming out with a new updated book on rule breakers later this year. And I couldn't find any reference to that when I tried briefly this morning, but definitely want to look forward to that and get our hands on that and take a closer look. But really nice presentation summary here by Notebook LM. You can see that some of those companies are definitely early stage demonstrations of some fairly rapid growth companies over the last 10 to 20 years. And basically they walk through a pretty quick analysis of the stuff that you see listed at the bottom of the page there. And that was what was basically highlighted or bullet pointed as talking points by Notebook LM. Okay. Any thoughts here, Ken?
No, I was
does this
answering a
pass?
question from the audience, so I'm.
No,
I don't want to say I wasn't listening to you, but I was only halfway listening to you, Mark.
I'm
Okay,
used to that.
I know you are.
And you know what I find fascinating? This would be the one of the highest probability lists of failing to pass the Kavula test, but I think it does. I know you've got this one.
Well, I own Mercado Libre. I have confessed to some of my closest associates that I have a personal position in Palantir.
Oh, okay.
I own Amazon and I own Nvidia. All
Oh,
four of those I
yeah.
own personally. So
I
yeah,
don't own Mercado Libre, but I have Tesla. So there's your full disclosure, everybody. I also have Palantir, Amazon, and Nvidia. I really wrestled with Palantir for Saturday's presentation, and I'll probably continue wrestling into the evening. But yeah, these are early stage, high growth companies that we're basically going to talk about a bit here. All right,
my wife has been kind enough not to ask me what the PE of Palantir is, Mark. So
well, let's answer the question. It's right here.
well,
And this
I
is
know, and I'm pretty sure she knows as well, but she hasn't asked. So
well, the point is, and they spent a fair amount of time talking about this. If you're identifying a breakout leader or a top dog in an enterprise, and again, you can look down this list. You can see a company like Amazon. They basically put the bookstores out of business. Um, Netflix notoriously put Blockbuster out of business, and you can kind of go down the list and talk about, how these companies became leaders in their industries. But when you look over to the right, and these are current numbers, most of those PE ratios are, I'm going to sugarcoat it and say they're frightening to most of us. Is that fair?
I think that's ultimately fair. And I think it's a lesson that I learned, Mark, when I and an audience of about 300 people and a lot of folks that I was sitting on the panel with laughed when Hugh McManus picked Amazon for our roundtable portfolio. The laughter was throughout the entire room and from the panel that how would you pick a stock with a PE like that? But Hugh has lived to prove us all wrong about looking at some of these breakout stocks and understanding that the PE is not a very good measure of a stock that is growing by leaps and bounds and is moving into uncharted territory.
Yeah, and we've talked about the life cycle stuff and the S curves and all that stuff, but when a company is truly early stage, PEs are rough, and that's part of the acknowledgement here. When I bought Palantir, it was in the $70 to $80 range, and the PE was, I don't know, 150, and I had to hold my nose and look away from the keyboard when I hit send, but I wanted to test and live in this world a little bit. So yeah, I will bring back the Hugh McManus experience on Saturday morning. All right, so here is just some context. This again goes to that Hugh McManus moment. If you're doing this, you pretty much have to do it with not years, but perhaps even decades in mind. And here's that Hugh McManus moment with Amazon. And by the way, it wasn't just laughter. He didn't get a single vote from a room full
No,
of about
you're right.
200 people. Not a single
Yeah.
vote. I raised my hand, by the way, after hearing the presentation. And Amazon since then has managed to return nearly 27%. That's since 2014, everybody. So $1,000 has become nearly $14,000. So that's the type of thing. So you have to really be in these for the long term, and you will be tested. Your metal will definitely be tested by any sneeze or whatever's going on. There's your Costco. That's one of the first stocks selected for the roundtable back almost 15 years ago.
Yeah, and it took us a long time to learn our lesson, Mark, because we still didn't ever pile in a second time on Costco, even after it started to prove itself as such a behemoth in the retail industry. We only piled in 4 more times on Microsoft overall, 15 years of the roundtable. Booking is a relatively small number of choices, as is Amazon, as is Google.
Hmm.
It's taken us time to understand that some of these stocks, it would behoove us to buy 2 or 3 times in the roundtable instead of focusing on some of the less fortunate stocks that we've added to the portfolio.
And you know, when it comes to true confessions, I'm the guy who stood before an audience in Silicon Valley in the late 1990s, and basically an audience member asked me, well, what do you think about investing in Google? And I said, hey, it's a great search engine, but how are they ever going to make any money? Okay, and you follow that up with a few years later, somebody asked me about Costco, and I said, hey, it's just Walmart. How hard can this be? You know, and they're going to have a lot of competition. So yeah, maybe
I'm
don't listen to me. Give me some time here. I'm desperately trying to learn my way,
I'm
through this minefield.
I'm chuckling, Mark, because that phrase from Google, I can hear myself saying in 2010, 2011, when 2 of the clubs that I was involved with at that point were considering Google as a possible stock to buy. We kind of downplayed the fact that all it was a search engine. Not enough research, not enough was known about all the other things that were going on with that company,
Got to have an open mind.
and not enough future sight to look at a brand new business model, because Google's business model to give everything away was a brand new model that didn't exist in very many places, and it proved to be quite profitable for them.
Yeah, we'll probably go back and take a look at our life after Google sessions from a couple years ago, almost 5 years ago now at Bull Sessions. So good stuff. All right, so here are just some other reminders that these are companies that typically have double-digit uh, growth expectations, whether it's cash flow growth or sales or book value. Um, Pretty powerful stuff. So that's just one more characteristic of these type of companies that you want to be quite mindful of. How long can they continue to do that? And then here is the way that David Gardner thinks about these type of companies. And he presents it as, if you're not the lead dog in the Iditarod dog team, the view is pretty nasty. You want to be that lead dog. Now, in the image that I gave you here, those dogs have all turned around to smile for the camera by the musher on here. But again, thinking in terms of by the leaders. And you can see that the characteristics are there, high quality. And
I think the rule might be stated in a single sentence also, Mark, something along the lines of, if the company is truly disruptive, then give it a second chance no matter what the metrics say. I
mhm.
mean, we're looking at a list of companies here that for the most part disrupted the entire world. Not every single company on the list, but certainly golly, the only one I can't speak to directly is Axon, because I don't know very much about the
Well,
company. But
that's the
all the
Taser
rest of
company.
all the rest of them are certainly disruptive to the world.
Axon is basically law enforcement and tasers and all that kind of stuff. And I think I mentioned this a few weeks ago when you were talking about your law enforcement bolas where you're going to trip the guys up without using tasers and all that kind of stuff. I was actually going to challenge your. I was agreeing with your premise, but going to challenge it with this company instead. I should have done that, and because your company didn't work out quite as
My
well.
company was a disaster, and I'll be the first to admit it. But
All
so
right,
be it.
so we've talked about this a number of times about how much we struggle as a community with these type of companies, and we're not alone. This I could actually put that on this slide. You are not alone when it comes to this struggle. And what I would draw your attention to on the right, again, you've got the projected annual return. That's the consensus forecast uh, for those companies. And then next to it, you've got the value line average return forecast, and you can see there's a fair amount of fluctuation. And then take a look at that Morningstar column. they think a number of these are monstrously overvalued. And then you've got the analyst consensus for price to fair value. Again, that's the comparison of the current price to what they think the fair value is. The analysts don't even have an opinion right now on Palantir. They're having a lot of trouble with NVIDIA, and we have experienced that also. So as you look down that chart, notice the variations. You've got the analyst consensus on Netflix is companies are on sale. Well, Morningstar adamantly disagrees. I mean, this number is dramatically different than the number next to it. So what this chart really shows is that theme that we have talked about a number of times when it comes to these type of companies. It's tough to find agreement. And again, I mean, this number up here, value line, does not seem to be able to characterize Palantir, at least versus the other people out there trying to characterize the company. The one I find kind of fascinating, and one of the reasons I will use it on Saturday morning, is there is consensus here. These numbers are all pretty solid. The company has matured enough and is executing quite well. You could throw NVIDIA into that pile also. Thoughts?
And there's room for disagreement also. My club met last night, my personal club met last night, and we added to our Mercado Libre holding because our SSG gives us a par value of almost twice what the data set gets from Manifest, what the data shows that Mark uses when he puts together the studies for Manifest Investing. We're showing about a return of somewhere in the 15-16% range, and Y-Charts is showing at less than 9% projected return there. So there's room for disagreement. There's room for listening to a lot of different sources and trying to sort it all out. I'll tell you, I became a true believer in Mercado Libre after I sat down and very carefully went through their investor relations video. It's a very long video program. It is just full of all kinds of statistics, but the most telling statistic to me was that the movement of e-commerce into the general population in most of the world is at 6, 7, 8% of the population, and in Latin America it's at less than 3% of the population. Right there you have a tremendous growth driver moving forward for a company that's focused entirely in Latin America. So there's a lot of good things you can do when you're looking at these kind of companies. And Mark's right, the PE doesn't tell the whole story. It never does in companies like this.
Yeah, in the case of Mercado Libre, you also have this thing of fairly wide open potential when it comes to the scalability. They can take on a whole lot more customers without incurring the same amount of incremental costs to run the operation. So as they expand out and gain more customers, just like Amazon did, those profit margins are going to probably exceed current expectations. Probably going to exceed the current expectations there, not to pick on anybody. But yeah.
Well, and we always speak of Mercado Libre as like the Amazon of South America, or the Etsy of South America, or these different warehouse kind of companies of South America. But that's only about 2/3 of their business. They have more than 1/3 of their business is in fintech. Where they're doing financial transactions for people that can't afford banking, that don't have access to banks, that are so rural that they need a different way to deal with financial matters. And Mercado Libre has turned that into more than 1/3 of their business. This fintech tie-in to the workplace, to the warehouse workplace. So there's a lot of good thing to say about Mercado Libre.
So again, your takeaway from this one is you're not alone, and the struggle is real. There's no doubt about it. You're going to run into places that really challenge your perspective on the planet. Here's just a quick reminder of how challenging this can be. And what you're looking at here is, again, David Gardner basically saying, if you're in it with one of these companies, you got to be in it for the long haul, all in. And what you see is the number of times they have issued buy recommendations for Netflix. And notice that there's only one where I guess they got cold feet right out of the gate and then they came back. But here's a question for everybody here in the audience. Would you have been able to? Well, first of all, back here, it went from 400 something down to 200, basically cut in half or more back in that time frame. But how about this one, going from $700 or $800 a share down to, call it 200? Can you actually sit there while your stock goes down 60 or 70% and maintain your resolve and your commitment to a company like this? And it's got to be one of the more challenging aspects in the world of investing.
I will give you a personal story, Mark, that I help some of my siblings manage their money. And I will tell you that I sat with one of my siblings who bought Netflix at less than $100, saw it go up to 600 or something, and then saw it start to fall and held on till about 300 and then got cold feet.
And that would have been
Maybe
right,
if she would have
right
just,
there.
yeah. So that premise about buy low, sell high is easy to reverse in stocks like this, where you buy or you see it at a high and then you hold on and you get scared on the way down. Once it's moving down like that so quickly, it's really hard to gauge where it's going to bottom out. But maybe at that point you just hold on for dear life and ride it like a roller coaster. I don't know.
That's what David would say has been
Yep.
done. Here's a look at that same information on a chart that's more familiar to us. It's a log chart, so it kind of smooths things out, but you can see some of those actual numbers. This could not be easy from here to here. I mean, it's not easy by any stretch of the imagination, but notice that it never really got down to being oversold, down around 20. And the other thing that we talk about a lot for companies like this, they can be overbought for a very long time. That's a really long time, what I'm circling. And it basically crested out a number of times along the way, including fairly recently. So,
Well, we
yeah.
might have even have a little bit of overbought in the last 6 or 7 months there. Might
Mhm.
have just gone right above that 70 line just a touch.
So that's something to keep in mind. And why I threw this in here because I think we have one of these right now, Ken. Novo is just irritating me, and I was grumpy to start with, and this just makes me grumpier. This is the GLP-1 expansion right here. And then, well, maybe this isn't so sexy as everybody thinks, what's happened on the far right-hand side of the chart, but I think long-term this company is fine. Maybe we draw our attention to that blue line. It looks like that blue line has formed kind of a support area over the last 20 years, and we're there now. So, if you make a motion to sell Novo from the Buttonwood portfolio, I'm probably going to say, why don't we give it more time?
There's no motion coming for that. I'm a firm believer in this company, and my wife happens to have this one in her IRA. So,
Yep, and we do too. We've got this in our personal accounts also. So we may be a little bit biased, but at the same point, it is a valid point. All right. And then they talked a fair amount about Tesla. I do own a few shares of Tesla. In fact, I bought it right here at $100. That point right there. So I get one gold star for today, Ken. But I've gone from 100 to 500 back to almost 200. And they talked about how we're going through, no matter what you think of certain individuals, leadership individuals, or the cars, which people are setting on fire, all that stuff that's going on, they do seem to have a pretty good thing. That blue line's pretty formidable. And yeah, maybe you have to weather a storm with a company like Tesla also.
I'm
Guessing.
just I'm just wondering how many times you can believe a guy making a promise that he doesn't fulfill. You know, fool me once, fool me twice, fool me 5 times. I'm not quite certain that I'm going to fall for it yet again. So
Yeah, I'll get really concerned if he phones that in from Mars. So that could be good. All right. So again, here is just some of the summation of stuff from Notebook LM. And sometimes you have to be willing to go a little bit on hope, more hope than we usually do for a company that meets these characteristics. Again, thinking top dog, like it says down here, thinking very long term. So, any other thoughts from overall thoughts here, Ken?
I just got to thank you for my comments about Mr. Musk. So
Well, yeah, there's definitely a divided opinion out there for sure. All right. All right, so let's go on to the mailbag. This is a question from Robin that came in, basically talking about Axos Financial, company that their model club sold at the beginning of April. I love this. That must mean that Robin, you disagreed, or at least the club was in a non-consensus moment or something. Sold at 60. The person who follows the company recommending a repurchase. Cool. Earnings and PTP have been falling over the last few quarters. Search for a reason, found some increasing costs, no big deal. But why does Axos, have a high quality rating and a high projected return after these downturn in fundamentals? And
Mark,
then
before you answer that question, I'm going to remind you about where that unwillingly comes from. Remember that this was the club that set trailing stop losses for a lot of their
oh,
stocks,
that's right. That's right.
and
I'd
then
forgotten that.
it was sold out from underneath them. So that's where the unwillingly comes from. Nobody in the club wanted to sell Axos, but they set a stop loss. And when the market cratered in April, they lost about half or more of their portfolio to those stop losses.
Okay, now I remember. So I take back what I said. And yeah, that makes a lot of sense. And then after the bull session, we mentioned this last week, Matt had made a post on ASML sharing video from ASML, and she had a hard time finding it. So let's take that one first. And then she also wants to know how to rename a dashboard from Vivio. This is one of the things that I think a lot of people miss. Searching and researching can be something of an art form, for sure. If you were to put ASML in here and go and look at the company report page, you might be able to get to it. But this is just for the stocks only on the right-hand sidebar. This right here is a full site search. So if you search on that, if you click search on that and go after your topic, try to, use some type of a unique phrase or a word to go after what you're searching for. And I'm with you there, Robin. I spent over an hour looking for something that I found with a chat bot in 15 seconds last week. So I know how irritating it can be. So here's what we're talking about. Click on this search. What you'll get is the opportunity to enter. And in this case, I said Matt's last name and the company ticker to try to nail it down. If you hit go, you actually get this display. And so you've got a couple things to check out. I believe Cy Lynch actually brought ASML to this, and Matt was also on the program. So that's how it ended up here. It's not what Robin was looking for, but both of these were what she's looking for. So that's the quicker way to find it. Again, use the site search to look for something like this, and try to come up with a fairly unique phrase and go for it that way. You can try your search for the word excellence and find the article on the site. Anything you'd like to add to that, Ken?
No, but just to say that this is not an AI engine. This is just a old-fashioned search engine. So it's not as smart as some of the AI engines are. And I have learned quickly that if I can't make the particular piece of software do what I want, I'm going to go to my AI engine and ask it why it's not working or to do it for me. And 9 times out of 10, I get a pretty decent answer.
Mm-hmm. All right, and so here is on another one of the sub questions she asked, dealing with a Bivio dashboard that's imported from the club accounting software, and you basically end up with this name being injected into as the name of the portfolio or the dashboard. And while you're on that screen, Robin, you can actually go ahead and type over, enter your descriptive for it, and it will actually save it. And you can see that that has been saved here. So you can actually rename while you're in the process of importing and saving that dashboard.
Well, let's also say, Mark, that you didn't know that and you just put it into your list of dashboards. If you just hit edit on that list, you can edit all or part of the name on any dashboard.
Right.
I have a dashboard for each of my clubs that I keep up to date because it's on a shared space with the whole club. And I edit it every time I look at it for something or add a stock to it or delete a stock from it. I edit the date in the name so that folks know that I've gone into it and done it at that particular time. You can edit the name any way you want, and that means erasing the whole thing and putting a new name in there if you want.
Mm-hmm. So it's a form of version control also in what you're doing there.
Yep.
All right, and now here's your question about the stock. Axos Financial. I went ahead to this is the Chronicle on Manifest, and I shut off the price and anything other than the quality. Just left the quality up to demonstrate this is a company that has had consistent quality. Going back a little bit further down here, again, excellent quality and fairly consistent over time. I don't see a whole lot of fundamental damage here. There's one down quarter here at Value Line, but just looking from top to bottom, looks like the fundamentals are pretty much intact as you study the company. A little bit of a downdraft there, but not anything major. And so here's what you're basically looking at. The answer to the question, why does Axos Financial have such a high quality rating? Well, first of all, let's start with the All-Star report here. Earnings per share stability. Try to get straighter than that, right? I mean, every dot on that line hits the trend line. So that's just fine. Financial strength, this is an interesting one because Value Line is being stubborn and maintaining a B rating, which is basically below average. So that's the one chink in the armor here on the quality rating. And the other two aspects that Ken was talking about earlier are we compare the growth of Axos Financial versus the industry. And, for the average bank, 8 to 10% is pretty good stuff. So these guys are above average when it comes to growth. When it comes to the profitability here as the return on equity, that 17.8 is again pretty superior. The average bank is probably in the 12 to 15 range. So they're better than average on both of those, way above average when it comes to stability. And what we do is basically add those up into that raw score that you're going to learn about, and then we rank them. So it ranks in the top 4% of all companies. Notice that the stability of the profitability is pretty much outstanding also. Anything you would like to shed there, Ken? I mean, this company's been around for a while.
Nice explanation. It's been around for a while. Here's a bank with no branches. It has absolutely no branches. It's completely online and it's nationwide. So it's a whole different business model. It's going to be disruptive to the traditional banking sector. We'll have to look, 20 years from now to see if they've made huge inroads into the process of making banking easier for folks. I know a lot of traditional banks are moving to allow you to do things remotely and to allow you to access all of their tools from wherever you happen to live. You don't have to be in the neighborhood anymore to go to a neighborhood branch. So we'll just have to see if a totally online bank is going to make it with the competition that's out there.
Okay, so hopefully that gives you some insights, Robin, on the questions that you had. Keep pressing on, and I'll go back to your question here. Not foolish at all. There's nothing foolish about the questions you're asking. Keep them coming. All right, I think that takes us to the end, Ken. There's a quick reminder that we do archive all of these sessions on YouTube on the page, whether they're bull sessions or roundtables. And those are up to date on the page. Not up to date here quite yet. There's a couple missing. And then here's just a quick reminder that Ken and I will be doing 2 sessions on Saturday, this coming Saturday. You know, Ken, I probably should get some slides to you, huh? Selections.
That would be nice.
Slides.
Yeah,
But
that would be very nice. So
2 full days of programs, the first on June 7th, the second batch on June 14th, as it shows down here. And the one thing I don't think it mentions on here is that if you register for this, you're eligible for a discount on next year's national convention. So that's something else to consider. I don't think that's on this page. It's not.
No, it seems to be late breaking news. It didn't come out in the Better Investing Weekly, but the volunteers heard about it. I did get a confirmation from Carolyn Fox.
Okay.
That is true for all registrants.
Okay. So that affects how you think about that price a little bit. I don't know the details on it. Do you have any more details than that, Matt?
No, well, the only thing I know is that the discount will only be valid through July 31st. So they want early registrations, but registration isn't open yet. I presume they're going to talk about that maybe as they close on the 14th, but I do not know how much the discount actually will be.
well,
Okay.
and at this point, Mark, they're also talking about a live convention next year. So we'll have
Yes, it is a live
It-
convention next year.
at this point it's live. Yeah.
Did they disclose the location yet, Matt?
The location has been chosen and not disclosed.
Okay. All right.
It will be shortly. I'm told, again, I expect the participants may know about it. It will be not in the June-July issue, but the next issue of BI Magazine.
Cool. All right. And I
So
think
they're kind of on schedule.
good. I think I've mentioned this in the past. I fairly recently watched the movie 12 Angry Men. And
Our audience is telling us where it's going to be, Mark. Okay.
Okay. Well, good for them.
Our audience is mentioning that Chicago is on the list, so we'll see.
I knew it was on the list of preferred locations. I didn't know whether that decision had been made. Anyhow, if you've not seen this movie, it is available in various streaming services. This could be characterized as an inside look at one of Ken's investment club meetings. And the reason I put it up here, I mean, I'll play the spoiler alert. One soldier basically questions the case that's been made and is quite fervent about it throughout the entire movie. And I just put this up here as, again, in combination with the theme we had today and rule breakers, sometimes you just have to have an open mind, lean back and listen. If a club partner is making an unusual presentation, you know what? They might be right. So, Ken, what would you characterize?
Well, I will say, Mark, that I belong to 5 different investment clubs, okay? And only one of them is majority male, so that'll start there. Right? And I will also say that the demographic of this group looks a lot different than the demographic. There's a couple guys in this picture that would belong in some of my clubs, but for the most part, this is a much younger demographic than I'm used to seeing in my investment clubs, at least.
Well, this would actually fit the demographic of the average 1960s investment club until dramatic and wonderful changes evolved over the next couple of decades. So that being the right kind of club. All right. Anything else here, sir?
I have nothing else to add, except I hope we see you all again at our next bull session next Tuesday. And thanks a lot for coming today. We appreciate it.
All right. Take care, everybody. Let us know if you have any suggestions for future topics or companies you want to kick around a bit. Take care.
Hey,
Good
Ken,
afternoon, everybody. Yeah, Kim.
I'm going to let you know that I'm not going to be here next Tuesday. I will be flying back from a wedding in Canada.
Okay, thank you.
She's seeking refuge from the humidity of Indiana in Canada.
They're going to
I'm-
let you into the country and out of the country, Kim. All right.
Well, if they don't let me out, at least I got relatives there.
All right. Good.
Well, travel safely, Kim.
All right, thanks, guys.
Thank
Good
you.
night, all.